Hey guys, so today we're going to explore 9 low-risk investments that generate for you a high return. Come on, this has got to be the dream, right? Low risk, high returns? I don't know about you, but when I think about the word risk, I kind of think it's a bit boring, but I know it's a very important topic. And one confusion many people have is the difference between what risk means and what uncertainty means. In my world, the way I think about it is to think of risk as being something that's in the eye of the beholder, and uncertainty is something that's inherent. By that definition, what you consider to be risky will be quite different to what I consider to be risky, because we have different attitudes to risk. A different way in which you can personalize this idea of risk is to try and quantify what risk might look like for you. For example, imagine you invested £10,000 or $10,000, for example. How would you deal with the idea of losing 25% of that, being £2,500 or dollars? Would that be okay with you, or would that scare you a little bit at that thought of losing that much money? This is why today's topic is really important, because I know there are many people out there who love to invest, but they're really scared of maybe doing it. So they'd love to explore low-risk ideas that give them high returns. As you watch this video today, I'd love to hear from you in the comments. Have you made any low-risk investments in the past that led to you generating some high returns? Let me know in the comments. If you're really enjoying this video, I'd love for you to hit that like button, as well as share this with somebody else. Do please make sure that you hit that subscribe button as well. My name is Ken of the Humble Penny and Financial Joy Academy. What we do on this channel is to give you guys the tips, the insights, practical hacks to help you work towards a dream life of financial independence and money joy. Right, one thing I want to say straight away is I'm going to be mentioning lots of different funds and companies and things like that. So things I mention on this video are by no means a personal recommendation to you. Okay, they're just purely for illustrations. I'm not giving you any financial advice, but just kind of give you some ideas around what I'm talking about. Right, let's jump straight in and explore these 9 low-risk investments that will give you a high return over time. Okay, so the first one is global bond ETFs. So rather than a normal exchange-traded fund, which is what an ETF is, which might track an equity index, this particular type of ETF will be tracking a bond index. These types of ETFs are great for helping to give you stability and diversification against stocks. They also offer you a lot of liquidity because such ETFs are traded in and out every day, such that if you ever wanted to sell that particular global bond ETF and convert that into cash, it will not be a problem for you to go ahead and do that. The other third benefit from doing this is that you also benefit from high returns, because such global bond ETFs can be used to generate returns in areas such as the emerging markets, or through you generating much higher yields from preferred shares. I mean, I did some research on what sort of returns you might be expecting to generate from such a bond ETF. And my research showed that you can generate a return of between 2 and 5% per annum on annual fees of around 0.1%. So you're paying 0.1% and generating around 5%, between 2 and 5% in returns every year. And in terms of providers, if you're somebody who wanted to go ahead and explore these global bond ETFs, I've found various providers that can help you go ahead and do that. So Vanguard is one of them, and it's called a Global Aggregate Bond UCITS ETF. The code for it is VAGP. The returns on that are really decent for the level of risk that you're taking, which is very minimal. I also found one by iShares, the iShares Core Global Aggregate Bond UCITS ETF, and the code for that is AGGU. Okay, so the second is to explore dividend paying stocks. So just as you might generate an interest by putting your money in a savings account, you generate an interest by investing in certain companies that pay you dividends. And they do that because they want to retain your loyalty over time and keep you as an investor in their particular businesses. The type of businesses that typically pay you dividends are ones that are quite boring in nature. They tend to be like utilities companies, phone companies, insurance companies, and so on. I'm going to pop a screenshot that I found of a list of companies here in the UK that are expected to pay dividends. Dividend investing was pretty challenging last year with what's happened globally and economically. Many companies decided not to pay dividends, understandably, but there's an expectation that as value stocks start to bounce back, this might be something that companies start to explore again in the near future. In terms of what you can expect in terms of returns from dividend income investing, you can typically expect between 4% and 12% dividend yield from companies that pay dividends. I'd say you should aim for around 8% max, because if a company is paying a yield of more than 8%, it's typically a red flag that that dividend policy might not be sustainable over time. Check out a video we made recently called How to Invest in Stocks for Dividend Income. I'm going to put that in the links below and above for you to head over there and watch the entire thing to guide you on what steps you should take if you want to explore dividend income investing for yourself. Number 3 is to explore high interest savings accounts. Now, these are the very boring things we've all been used to for so long, but do not sniff at them, because there are certain accounts that are still paying pretty good returns as at the time of making this very video. The real trick with them though is that you typically have to be an existing customer and have a current account with the banks that are paying these levels of interest. At the same time, you also have to contribute on a monthly basis, and thirdly, there are usually limits on withdrawals. As at the time of making this very video, I did some research to see what sort of rates banks are paying at this very moment. The likes of Lloyds are paying 1.5%, and the likes of RBS and NatWest are paying around 3.04% at this time of making this video. So it's for you to head over and do the research for yourself and seek out those particular banks that are paying you a decent return in order for you to essentially invest your money in these high interest savings accounts. The thing to mention with these is that the returns are guaranteed, so you know exactly what you're going to get. Unlike if you invested your money purely through the stock market, for example, there isn't a guaranteed return with that. But something like this, if it's a fairly decent return, for example, at 3.04%, which is above inflation, that sort of return being guaranteed is not really a bad option to explore if you're somebody who does not love risk, or perhaps who wants to diversify that portfolio to some extent. Okay, so number 4 is a bit of a random one, and I thought I'd just put this in here. And this is by no means a recommendation, but number 4 is to buy Amazon shares. Now, I'm sharing this from my personal experience. I looked at my son's investment portfolio, and he's up around 9 times on the money he put into Amazon. Well, we'll put it in for him many years ago. He's 6 years old right now. And I can't think about any other investment we've made in that time period that has generated that sort of return. And I thought I'd just mention this as something to consider, perhaps, because during this time that we've all been staying at home, I can't count how many times I've had to order things on the Amazon platform. And Amazon over time has become that business that has become very dominant in the e-commerce space. On top of that, they're becoming a lot more dominant in cloud computing, exploring new areas such as their own delivery service, as well as also exploring grocery and sort of retail type services. What they're doing essentially over time is diversifying their income. And I'm mentioning this as a company that's potentially explore for yourself, because I typically invest in companies if I can see that there's clearly value being created by that company at present and for the future. And Amazon is one of those companies that when I look at what they're doing, I can see that they are creating value in so many different ways. Now, the Amazon stock, as at the time of creating this video, is over $3,000 per share. So one way in which you could get involved in investing in Amazon is to buy fractional shares. There are many platforms that enable you to do that. One of them is eToro. I'll put a link to them below for you to head over and see if it's something that you might want to consider for yourself. Okay, so the next one is to explore property REITs. So a REIT, which is an acronym, REIT, stands for the Real Estate Investment Trusts. It's another way in which you can invest into the property market without actually owning physical property assets. I don't know about you, but it can be highly risky to own physical property assets. You're dealing with potential voids, you're dealing with maintenance issues, you're dealing with, all the palaver to do with tenants and all the stuff to do with maintaining a particular property. And the risk just carries on. There's so many things that can go wrong potentially, but there's also many things that can go right by you owning a physical property unit. But you might be somebody who says, well, actually, I don't want to spend all my money on stamp duty. I don't want to waste my money paying lawyers and doing all kinds of things in order to buy a physical unit. I want to actually explore investing in property, but doing it via a real estate investment trust, which essentially means that you are buying into the property market, but doing it via the stock market. Ordinarily, REITs are lowish risk investments, but given what we've seen economically in the last 12 months, the property market has had a lot of question mark over it, with many people having to work from home in various different ways. So I'm mentioning this as more of a longer term play for you to really consider this as a way in which you can expose yourself locally as well as globally to the property markets, but thinking about it from a long-term perspective. I found some interesting funds that you might want to consider as part of illustrating these very points about REITs. The first one's the Spider Dow Jones REIT ETF. Now, this particular ETF is there to help you invest in the wider US property market. Okay, if you want to explore the US property market, then this might be one to use as a way to gain that exposure at a low cost. Another alternative to consider, again, as part of illustrating this point and not a recommendation, is for you to look at the iShares UK Property UCITS ETF. This particular one is to help you, if you have confidence in the UK property market, to explore investing in that particular market without actually owning physical units yourself. Next is for you to explore government bonds. As the name implies, government bonds is where you're essentially lending money to a government. So it might be that you're lending money to the UK government or to the US government, for example. These are typically some of the higher rated governments to lend money to, with the expectation that that money will definitely come back to you, as well as a guaranteed return for doing it. Another way to look at this is to invest in gilts. And gilts are, I'm just going to read the definition, they're UK government bonds which are issued to help finance public spending. Okay, things called PIBs, P-I-B-S, which are permanent interest-bearing shares, are issued by the UK building societies and work in a similar way to bonds. This is another way in which you can also get involved with investing in government bonds ultimately. Government bonds and gilts offer a much better return than putting your money into a savings account. I did some research, just kind of show you an illustration of what I mean. I looked up one called the iShares 20-year Treasury Bond ETF, the code being TLT. And you notice on there that in 2019, the returns from investing in that bond was 14.93%. And in 2020, just last year, the returns on that was 17.92%. In addition, I looked at another platform, Vanguard, for what options they had for investing in government bonds and gilts. And I found a specific fund by the code VGOV. VGOV. The fund's called Vanguard UK Gilt UCITS ETF. And just zooming into that, I can see that last year, the returns from that particular bond, if you invested in it, was 9.55%. And the year before that, 7.49%. And it carries on like that. So you can see that you are able to generate some really good returns by investing in these government bonds, but it all comes down to essentially the credit worthiness of the specific issuing government that you are backing, whether it's the UK government or the US government, for example. The next investment to explore is gold. Now, I know gold's absolutely popular, but it's very important to understand where gold potentially fits into your portfolio. Gold essentially acts as a hedge investment, an alternative investment that moves in the opposite direction to equities. So when stocks fall, there's usually a rush to gold, and people usually invest in gold as a way to offer a bit of a hedge. Now, gold has almost always gone up in value. It hasn't always gone up specifically in value, but it's almost always gone up. If you look at the chart over time, gold has almost always gone up in value. And there are different ways in which you can go about investing in gold. You can go about owning physical gold, but then there's a problem around how you actually store that physical gold and things like that. An alternative way to do it via an ETF, an exchange traded fund. And I found one called a Spider Gold Trust ETF, the code being GLD, which is fully backed by physical gold. So this, again, is not a recommendation, but it's something you can go about exploring if you are somebody who is interested in gold as an asset class and wants to learn a bit more about how you go about investing in it. The next investment choice is corporate bonds. So very similar to government bonds, but instead of lending money to governments, you're lending money to highly rated corporate type companies, okay? And by doing this, you are then being paid a return. So companies with a creditworthiness of B+, i.e. in terms of their rating, B+ or better, are typically ones that you want to focus on. You want to focus on B+ or A-rated corporate bonds. And the beauty of investing in these type of bonds is that you know exactly what you're getting. You know what your returns are going to be, and you know when you expect your actual initial investment to come back to you as well. Now, in terms of returns, these can vary, but from my research, I can see that you can expect to generate a return of between 3% and 5% per annum with an annual cost of around 0.09%. So quite a low cost for the levels of returns that you're getting. I found a specific fund at Vanguard as part of my research. That fund's called the USD Corporate 1 to 3 year Bond UCITS ETF. The code for that is VUSC. And being a 1 to 3 year bond, you can see it's a short dated bond. And for that, you are expecting a guaranteed return over the time period that you are looking to invest your money in it. Okay, so the final investment, and I couldn't do this without actually mentioning this one, is for you to explore investing in the S&P 500 index. This is by far, and I've written here, it's possibly the lowest risk investment for beginners. Why? Because you're investing in 500 of the largest companies in the US equities market. Basically, some of the largest companies we are aware of in the world in many cases. So you're looking at your companies such as Amazon, Apple, Alphabet, Microsoft, all those companies are on that index. And that index is also self-cleansing. By that I mean, if a company is not performing very well, they're typically removed from the list and a committee votes in an entirely different company to join the list. So essentially, you have your money spread out over 500 companies, fully diversified in so many ways, but giving yourself a really high return over time. Typically, you can expect over a long-term period between 7% and 9% thereabouts per annum as an average return for investing in the S&P 500. It also has super low volatility. By that I mean in terms of how the price of that particular index varies over time compared to you maybe holding an individual stock by itself. And that low volatility essentially translates into low risk. And by getting involved from a low risk perspective, you give yourself the highest opportunity of generating a high return by investing in that particular index. Now, you can explore investing in the S&P 500, by approaching your existing broker. So many brokers that essentially give you the option, they give you the ability to invest in the S&P 500 either via an ETF or via an index fund. If you've not seen our video on understanding the differences between index funds and ETFs, I'll put it in the links below and above for you to head over and check it out. In addition, I'll also put in the links below a very popular investing video that we made to guide you as a beginner investor. If you're that person who's kind of starting off and trying to work out how you go about doing this, I'll put those links below also for you to watch that video on how to start investing in the stock market as a complete beginner. Guys, I really hope you've enjoyed this video today on these 9 low risk investments that give you a high return over time. I've made this video today just to really highlight the point that there is something for everybody when it comes to investing your money. If you're somebody who's risk averse, or if you're somebody who's risk loving, there is something out there for you to make sure that your money is not losing purchasing power to inflation, but that your money is actually invested and generating a return for you over time. I'd love to hear from you in the comments. Which of those 9 ideas that I shared would you love to explore as a way to get started with investing or as a way to diversify your portfolio? Let me know in the comments. It'd be very interesting to see which of those options you're going to be exploring further in your own investing life. If you've really enjoyed this video, hey, hit that like button, hit the share and share this with somebody else, as well as hit that subscribe button to show some support to us here at The Humble Penny. Thank you so much for watching this video today. And as ever, in all things, be thankful and seek joy. Take care, and I'll see you on our next video. Bye for now.